Hello, everyone. Welcome back to Market Brief Podcast. Today, we are diving into a hot topic making headlines on Bloomberg. The Chinese stock market entering a bear market? Really? Let's break it down for you. What's happening? Why is it happening? And how you, as an investor, should navigate this situation. Bloomberg report that Chinese stock market has officially entered a bear market, dropping over 20% from its October high. In just the first 7 days beginning of this year, Chinese stock fell already 5 of them. The MSCI China dropped 1.5% last Friday, and CSI 300 covering stock in Shanghai and Shenzhen was down 1.3%. Since the start of the year, it's already lost 5%. Not a great year for Chinese stock, right? But why is it happening? Well, there are both external and internal factors at play here. Let's start at the external factor first. This year, Chinese stocks are facing significant geopolitical risks, most notably from the US. There is an ongoing trade war, export bans on US companies selling to China, and Chinese companies like Tencent and CATL being blacklisted, restricting their ability to trade with the US. But that's not fair to blame only the US for having Chinese stock market underperformed. The real issue here lies within Chinese own economic challenge. Since the beginning of the year, economic indicators from China haven't been promising. The PMI manufacturing is down, though the service PMI shows slight improvement, driven by a recovery in home sales across 30 major cities. But here's the real concern: inflation. China's inflation in December was just 0.1%, while producer price fell 2.3%. Listen again, it's minus 2.3%. Even core CPI only rose 0.4%, excluding energy and food already. The real price of the real product increased only 0.4% compared to last year. What does this low inflation mean? What does this low inflation signal? It signals weak economic confidence. This is reflecting in China's bond yield 10 years, which dropped to only 1.6%. Investors are avoiding Chinese stock and flocking to bonds, a clear sign that they don't believe in the recovery and economy. China is now facing deflation, which is a major economic threat. Deflation caused consumers to delay spending, expect price to drop further, which reduced overall consumption. This led to a vicious cycle of lower production, less employment, and declining income, a deflationary spiral that's incredibly hard to escape. Even with efforts from Chinese central bank, like lowering reserve requirements ratio and cutting interest rate, economic recovery remains elusive. Credit growth is shrinking because people are hesitant to borrow, whether it is to buy home, buy products, buy goods, or invest in the businesses. China has tried various measures to stimulate the economy. In real estate, they have cut down payment to only 15% for down payment, those who want to buy a second home, and eased home buying restriction in major cities. On the stock market side, there's been an injection of liquidity. Institutionals received 500 billion yuan to purchase stocks. Company got credit 300 billion yuan in loans for stock buyback, and national fund stepped in to stabilize the market. But even with these unprecedented measures, the Chinese stock market hasn't bounced back. So, how are these institutional investors approaching Chinese stocks this year? Interestingly, many long-term investors or buy and hold institutions are staying away. Instead, hedge funds are treating China as a trading market instead of a core portfolio holding. If this trend continues, China's market risks losing long-term institutional investor capital, leaving it dominated by short-term speculators. So, here's my view for 2025 Chinese stock market. I think it will be just another challenging year. Passive investments in indices may deliver negative returns because last year's rally was driven by policy announcement and PE expansion, not earning growth. For investors with a full portfolio of Chinese stock, I would recommend reducing portfolio, reducing exposure, and reallocating to growth market elsewhere. But if you are an experienced investor, I think being selective is a key. There are still Chinese stocks with a strong fundamental and unique growth stories outperforming the broader market. So, what do you think about Chinese stock market this year? Are you still investing or are you sitting this one out? Let me know in the comments below. And don't forget to subscribe to Martina's channel, Market Brief in English, for more investment insights. See you next time.